Okay, let's see. This is my first time streaming, so if anyone, just bear with me for a sec. Okay. Okay, so let's check out what's going on in the market. It's kind of a mixed day today. Let me see here. I just want to see that everything's working out. Okay, perfect. Let's see here. I just want to see that everything's. Okay, perfect. Yeah, so mixed day in the markets today. It was a really good day yesterday, based on Powell's comments. So not surprised to see a little bit of a pullback. It's also the end of the week, so a lot of people are taking profits. All their day traders and swing traders taking profits. I think what I'm going to do for this stream is probably take a deeper dive into a couple of stocks that you want me to look into. So feel free to just drop them in the chat as they go by, and then we can take a look at them and I can sort of share some thoughts. But right now, some of my thoughts in the market, Corsair is pulling back quite a bit. Interesting to see, because we talked about this one after their Wall Street bet surge. And I mean, they surged all the way up to $40 or $42, something like that, and they're just pulling back. But keep in mind that Corsair, like 70% of it or 60% of it is owned by EagleTree, right? So it's something that, let me turn this off. It's something that is keeping the stock artificially down, because if you have an institution that owns 60 or 70% of your entire float, then every time that stock goes up, then the institution is just going to sell. So until EagleTree eventually goes down to something more reasonable, like 10% or 15%, we're going to see Corsair depressed for a long time. And honestly, I think it's a really good thing, right? Because if you think about it, this is an opportunity to get the stock so much cheaper than you would normally get it. Because a stock like this, I mean, the only downside with Corsair that I see is the fact that it's large institutional ownership and they're a majority shareholder that they can just sell whenever they want. But other than that, from a fundamental perspective, the underlying stock is pretty solid, right? The balance sheet is solid, the income statement is solid, and they're trading at a really cheap valuation. So wouldn't be surprised to see it go much higher after EagleTree sells out their portion, right? But for the time being, let's pull up the daily chart. Look at this. It's just stuck in this channel until Wall Street bets broke it out of the channel. And as soon as they did, it just came crashing right back down, because probably what we're going to see is we're going to see that EagleTree sold a portion of their position. Generally speaking, they sell around June. So generally speaking, they sell around June, right? So it's right in line with when they would usually sell out their position. So until we can see that ownership going down to the point where they're no longer a majority shareholder, maybe they're 30% owner or even 40% owner, until we can see that going down, then probably what you're going to see is you're going to see Corsair trading in just in a channel like this, like it is right now. So I think I have the chat going. So if you have any questions, just feel free to drop them. I should be able to see them. And if there's anything that's broken, like I said, this is my first stream, so I just downloaded OBS like 20 minutes ago, and I'm just trying it out live. But yeah, so like I was saying, like you can see it's very clearly just trading in this like $34 to $30 range for Corsair. Once it breaks out of this, it will break out of this once you have more news around EagleTree selling more of their portion, right? The company by itself is growing quite fast. So I wouldn't be surprised to see it actually break out at that time. Other names that I'm looking at, I mean, Vuzix is kind of crazy, the fact that it's trading down. It's been trading down for the last several days. Interesting to see that really the shareholder day didn't have a big impact on the stock itself. I was expecting it to at least have some type of an impact. A lot of Vuzix shareholders that I follow on Twitter, everybody, like the sentiment that I've been seeing is really positive. So really interesting to see that it didn't really have an effect on the stock. There's probably macro pressures, to be honest with you. A lot of these funds trading in and out of the stock. So we'll see what happens with that one. I mean, it did surge all the way up to 30, but keep in mind the stock was like in the $2 range last year, right? So takes time. And especially takes time because, you know, if they surge from, let's say, $3 to $30, that's a 10x. That's similar to the type of move that Tesla did in 2020. And what they're doing is they're taking growth potential that they could have had in future years. They're front running that growth. And it's totally normal for you to see a pullback, for you to see a sort of stagnation of their growth, because this 10x could have been, you know, 2022, 2023, 2024 growth that you could have seen, right? And so we're seeing the same thing with Tesla. With Tesla, it went all the way up to 900, you know, from the 300 range. This box, I think I made it before, was when I was buying it. And it went all the way up to 900, and now it's been actually underperforming the index, right? It's been coming down, it's been chilling in this 600 to 700 range, because what it did was it took profits, or it took gains that it would have had in 2022 and 2023. And so that's generally what happens with these companies. They have huge moves up, you know, 2, 3, 4, 5x, and then they cool off for a little bit. Even with Tesla, same as with a company like Vuzix, you know, I'm expecting them to chill out for the next quarter, 2 quarters, and then prepare for the next leg up, because you have to understand that as you have the stock trading in these boxes here, what you have is you have an trading hands, right? The people who made mad profits in their run up from 200 to 900, generally speaking, some of them will want to take those profits, right? They'll want to sell out and they'll want to cash out of their profits. But what you have is you have investors trading hands with regards to that stock, and a new investor base is forming. Generally speaking, with a company like Tesla that's so hyped up, and even a company like Vuzix that has such a small market cap, if you see moves like this, you know, from $4 to $30, 700% that move, if you see that move, everybody who's a trader, whether it's a day trader, weekly, swing trader, everybody who's short term is going to sell out of that stock because they've already made their money, right? They had the 700% move, and what you're going to see in this other box is the fact that once the stock begins to cool down, you have a changing hands. And that changing hands, what that means is all the short-term traders are out of the stock, and who's left? Who's buying up those shares when the stock comes down? All the long-term investors, right? And so we're seeing it with Tesla, we're seeing it with Vuzix, that the moment that they come down and they start hanging around this sort of range and they start stagnating in their growth, you form a new investor base of long-term investors who are long-term focused. Because, like, honestly, anybody who's buying Tesla here at 700, anybody who's buying Tesla at 650, they're planning, at least I hope, right? But they're planning to hold it for years. Because from, a fundamental perspective, a value perspective, what have you, it doesn't really make sense to buy it at this range, right? So all the traders are selling out, and the people that they're selling their shares to are these long-term investors. Okay, so that's that. So hey, Stuart, nice to see you on the chat here. I'm doing well. Just experimenting live with my first live session. I don't think I'm going to be releasing the podcast on Spotify. I was planning on it in the beginning, which is also why I named this channel the way I did. But a lot of the episodes that I release are very oriented towards YouTube, because a lot of them have, I'm either sharing my screen or I'm sharing clips and like visual aids. So I don't know how that would work on Spotify. To be honest with you, I haven't really looked into it that in depth. Okay, so let's talk about a couple of other stocks. Happy to look into some balance sheets and some income statements for you if there's stuff that you want me to look at, interesting companies. I know that I've been receiving a couple of requests over time for things to look at. I just haven't had the time, and I'm just carving that time out today. Okay, so let's take a look. One of the other things that I found interesting, so I bought more Peloton the other day. I really, really believe in this company to climb long term. I think the recurring revenues for the business is essentially the fundamental aspect of why I'm personally buying Peloton. It's the fact that 2020, 2021, they've all been massively bullish for actual unit sales, but 2022, 2023, you're going to have recurring revenues in terms of those subscriptions, right? And so the thing with Peloton is, like, it's a $32 billion company, which you can see here on the side, and they're making single-digit billions in terms of revenue, right? So it's not really that big of a deal. From a price to sales perspective, you could call it overvalued 100%. But the bull case for Peloton, I think, is the recurring revenues, because there's going to come an inflection point, a tipping point, where they're going to be making just as much from recurring revenues from existing users as they are from new users buying their products. And when that tipping point comes, just get ready, because the stock is going to go into overdrive. Right now, a lot of analysts are looking at Peloton and they're thinking about, this is a pandemic play, this is a stay-at-home play. If people can go to the gyms, then they're not going to buy Pelotons, right? And that's true to a certain extent for the actual unit sales. But what you have to keep in mind is the recurring revenues that the units come with, because you buy, a $2,000 bike, and then you also have to pay a subscription on top of that monthly. And the thing with Peloton is that it's so sticky as a product in terms of having this community of people bandwagoning around the products. Even today, I was seeing people on my Twitter that I follow that are Peloton holders. They're posting, about the newest athletes or the newest trainers on the Peloton platform. And it's just really crazy the level of stickiness that Peloton has from the level of stickiness that they have from an actual consumer perspective, right? You don't have that level of stickiness with a gym or with like Good Life Fitness or with any of these other, physical locations, but you do with Peloton because of that community aspect, because of that gamification, right? You get points and you can compete with your friends, and it's really crazy. It's taking this whole concept of spin to an extreme, and spin was this whole trend, this whole fad in for years, and now they've leveraged that with technology. And so I think that all of that put together and the recurring revenues for Peloton is really the driving force for it to be spurred into the next couple of years, because of the massive sales that it's had over the past couple of years, right? So it seems like the market is taking a downturn right now. A lot of stocks actually falling: Nano-X, Vuzix, Corsair, Poshmark. Poshmark was another interesting one. That was one that I almost did a video on, but I never really got around to it. Bullish on that one as well. Okay, so let's take a look at what we want. Actually, I saw a lot of news around Roku today. Roku was a company that was, I think their CEO was on CNBC today, and he was talking about Roku. Let me see if I can find it. Yeah, so how Roku dominated streaming video and why CEO Anthony Wood is now obsessed with content. Man, Roku is one of those stocks that I used to own years ago, and I sold it way too early. I think for myself, in my own portfolio, patience is the biggest virtue that I've learned over time, and that's the most painful lesson I think that I've learned over time, because I hadn't had it, and I actually bought Roku in 2019. I bought it in like the $40 range. I talk about this in that Fundamentals of Investing ebook. I don't think it's in the description here because I didn't know how to do it, but in any of the videos that you're going to see, I have it in the description. But there's a chapter in that book where I talk about how I got started, and one of the biggest winners for me was Roku back then, because I bought Roku somewhere around here in 2019 in the $30s and $40 range, and eventually I sold it. I think the highest that I sold Roku was $120, which is it seems like a flat line now, but like if we remove this, it was a crazy move, right? I think I sold it at like 120, 130, somewhere around here. And I think that, to this day will be one of my bigger regrets in the market, because this company is just a monster, and they're going to be a monster. And so, if they now focus on content as well, one of the things with Roku that made me really bullish way back when, and keep in mind I haven't visited the bull case for Roku in a couple of years, but one of the things that actually initially made me really bullish on it was the fact that they were coming pre-built in a lot of these televisions that were being sold in the States. And so it was this interesting strategy that if you had this Roku device pre-built in the TV, you were going to go very wide to a large amount of people without ever having to charge those people for your product, without ever having to sell your product. Because think of it from the Apple TV perspective or the Amazon Fire Stick perspective. Now you're asking consumers to pay $60 or $70 or whatever it is for the actual hardware device that links to your TV. Meanwhile, you have a Roku device embedded in your TV when you even bought the thing. So for you as a consumer, I don't care about what the device is. I really care about what the content is on the device. If my Roku device and my Amazon Fire Stick both have Netflix on it, then I'm not really going to pay an incremental $50 or $60 for the Amazon Fire Stick, right? And so the fact that Roku included their devices in all of these TVs pre-built was this massively bullish thing, because now what it did is it allowed Roku to actually expand the base of the total consumers that were using it. And then now you're seeing that now they want to get into their own content, right? Primarily they were an ads-based business, and now they want to do content, and you're going to see them eventually expanding. And so this idea is not an idea that's unique to Roku. It's an idea that I think is universal in terms of these businesses and the strategies that they take. And this is why I talk a lot about these growth companies, because a lot of their strategies, what it is going wide at the base and then going deep after that. And what I mean by that is capture the users first, and after you've captured the users, after you're the biggest force from a user perspective, then what you can do is you can start monetizing those users more and more, right? So, even with, like we talked about, like with Peloton, we're looking at them capturing users. We're looking at, how many millions of users do they have? But what you have to be looking at is like, how much can they monetize those users through whatever it is, subscriptions, merch, content later on down the line. it'd be very easy for Peloton to release their own, to partner with their creators and to have their athletes create their own like training packs and their own products that they're selling, right? They can very easily do that. It's not a difficult thing for them to do because of that initial stickiness, because they've built the base so wide. And going back to Roku, I think that that's one of the biggest strategies. Now, would I buy them again? I've really mulled it over for a long time, and it's been one of those stocks that I'm just sort of bitter about because it taught me an important lesson in patience and in the long-term perspective of having these companies growing. But to buy it again, I think, it's a $50 billion company right now. It does have the potential to go higher, but at the same time, when I was buying it initially, it was a $5 billion company. And so it had a much higher growth potential than it has now, because let's say in 5 years, I can see Roku being, a $200 billion company, right? I can see them being maybe 150, 200, yeah, sure. That's still like a 4x from here. Maybe the Roku price is like 1,200, but what it did was, like, when I bought it initially, it was a 10x up until this point, right? And let's say 2025, it could have been, from 5 billion to 200 billion, like a lot bigger opportunity than buying it right now. And so I love Roku. I think that they are going to increase. They can do 3x, 4x, 5x from here in the next 3, 4, 5 years. But I just think that at $50 billion, there might be better opportunities elsewhere. A lot of the companies that I hold, except for Tesla and Disney, I think all of them are under 100 billion in market cap, and most, if not like a vast majority of them, are actually under like 30 billion market cap. Fiverr's like 10 billion, Lemonade's like 5 billion, SoFi's like 18, 19 billion. So I'm generally speaking going towards the smaller types of companies, and the reason why is because I believe that they can compound so much more over time. If I buy, let's say, a Disney or an Apple, I can't expect them to like 10x. Maybe they can double, maybe they can triple over the next 5 years, and that's great. But if I'm talking about a growth portfolio where my main goal is compounding, then smaller market cap companies, generally speaking, are better for that because they have a higher runway for growth. Like Vuzix can 10x tomorrow, go from 16 to 160, and they'll still be a $10 billion company, right? They'll be like as big as like Fiverr. So there's something to be said about the market cap. Now, keep in mind that there's an inverse relationship because a smaller market cap means a higher level of risk involved, and so it's a trade-off either way. And this is why, in the last video where I talked about selling Cloudflare, I was talking about like the risk associated with wealth concentration versus wealth preservation. Stuart, glad you're enjoying the live stream format. Look, I think going back to the podcast conversation, I think I'm not sure right now because it's still early days in the channel, and like I said, this is my first live stream. I'm still experimenting with a lot of things, and one of the things that I'm experimenting with is the fact that, do I want to have more guests? Like, do I want to be more like a Dave Lee, where he has constant guests, or do I want to be more like, I don't know, like a Jeremy from Financial Education, where he just does his own sort of deep dives, his own analysis? And depending on the decision that I go with, we can talk about formats. But I think you're absolutely right. I think if I do have more guests, then maybe what I can do is I can share just the guest episodes, the interviews on Spotify, and not necessarily the shorter form content. Because, if I make, let's say, a video that's 10 minutes, I don't think that would be worth a Spotify episode. I don't know, you can prove me wrong, but I think the incremental value would be much higher if I did, let's say, a guest interview on Spotify that's an actual like 40 minutes, 50 minutes, 1 hour. So the good thing is that, I have the episodes, I have the videos on my computer, and I don't need to, put in any more time. I can just upload them en masse on Spotify in the future. It's just a matter of positioning on like, how do I do it best for people to actually enjoy and consume that content. But I think if people want to see me do more interviews, if you have suggestions for who you want me to talk to or reach out to, then I'm happy to go through that path. It's just whatever provides the most amount of value, I think, would be good for me. But so yeah, those are my thoughts on Jumaya, on Vuzix, on Corsair, on Peloton, and now on Roku. If you have any other stocks that you want me to sort of look at and share my thoughts, happy to do that right now. Just drop it in the chat. One of the other companies that I've been looking at, so I have this buy soon column here, and this buy soon column, you can see Roku's on it. Squarespace, I'm really surprised because Squarespace had that blockage at 53 when I made a video about them, and they seem to have broken out of that. Really interesting to see this company be $9 billion. Honestly, sometimes it irritates me to see some of these companies be valued at such high valuations just off their name alone. Just because I know that there's other companies that are doing better numbers that are the same sort of valuation. Let me see. Let me just see if Hypercharts has them yet or not. Okay, yeah, so I'm going to talk about Nano-X in just a bit, Stuart. So let's take a look. So Squarespace, yeah, they do have them. Okay, so let's just take a look at this. Hypercharts is a good place to just take a look at just the broad brushstrokes. So like we said in our video, Squarespace is growing 31%, 663 trailing 12-month revenue, and they don't have their market cap here, but we do. Their market cap is about 8.65 billion, which means that 865 divided by 0.663, I think it was. Sorry, I'm doing that backwards. Hold on. Or we can just make it easier for ourselves. Go to Yahoo Finance. I just want to see the price to sales ratio because, or it might be here too. Price to earnings, price to book. No. Let me just take a look at their price to sales, and just keep in mind that a price to sales ratio is just whatever they did in revenue by whatever their market cap is, just so that we can have a ratio for relatively speaking how over or undervalued they are. Because if a company is doing, let's say like Corsair is doing 2.1 billion in revenue for 2021, but they're valued at 3 billion, then if we buy it today, within a year, they would have basically earned their entire market cap or close to their entire market cap in revenue, right? So that's a pretty easy decision for us to make, because let's say we buy Corsair and at the end of 2021 they do 2.1 billion, maybe mid 2022 they do like over 3 billion all in all, everything included. Then all of a sudden, it's like we bought it for free, right? Because we bought it at a market cap of 3 billion. And that same multiple is going to be applied. So let's say 1.4 or 1.5 multiple is applied, right? So 2.1 divided by 3. Sorry, 3 divided by 2.1. Yeah, so 1.42 is the multiple, right? Is the price to sales. If all of a sudden, Corsair earns that out, and we apply that same multiple, then Corsair is going to be 5 billion or 6 billion, right, in the next year. Just from a fundamentals perspective, let alone catalyst, let alone news, let alone anything around the stock, they're just out earning their market cap in a very short amount of time, right? So people are still going to use that multiple in 2022 or 2023 to look at Corsair. So it's a no-brainer that the company is going to go up. That's why I'm super bullish on it. Okay, so let me see here. Yeah, so 12.3 price to sales for Squarespace, where it's at right now. But we can look at other companies that are 9 billion that are probably under 12.3, that are probably growing faster, which means that I don't know, man, Squarespace, it's just one of these companies that Oatly was another one of these companies that they're just so hyped up in terms of the news, that they just trade for so rich compared to what they should be trading at. Like Fiverr is growing 100% and they're still an $8 billion company. I mean, yeah, sure, they have a higher multiple, but I don't know, 80% margins on Fiverr too. Anyways, so let's take a look here. So Nano-X Imaging, could you provide your thoughts on how you look at stocks like Nvidia or Docusign? I have both, and they have both moved up 40%ish in the last month. Really like both companies. Would you sell part of the position and wait for a dip? Would like to know how you approach this, as they seem quite high. Well, okay, so Tom, so what we're going to do is we're going to go back to Nano-X Imaging because I want to take a deeper look at Nano-X Imaging. But first of all, for companies like Nvidia and what was the other one? Docusign. Yeah, so they've gone up. It depends on what your time horizon is, Tom, right? Like if you plan to hold for a long time, like I was saying with Tesla and Vuzix, if they've gone up a lot in a short period of time, generally speaking, they're due for a pullback and just a stagnation, so to speak. So it depends on where you bought Nvidia, right? But if you bought Nvidia, let's say at 500, like here, and Nvidia went all the way up to almost 800, then that's fantastic for you, right? What's going to happen probably is Nvidia is going to like track something like this, over the next several months, maybe. And what it's going to do is all the people who were in Nvidia or in Docusign for the short term, a lot of the people who are in it for the short term or for the swing trading, they're going to sell out. And the people that they're going to sell out to is they're going to sell out to the long-term investors. And what it's going to do is it's going to form a new base, right? And as it forms a new base, it prepares it for the next leg up. So that's generally what happens because of the short-term momentum, because of the short-term psychology. People are in it for different reasons, and not everybody is a long-term investor, right? Some people are in it just to trade the stock. And so for companies like Nvidia, for companies like Docusign, a lot of these growth companies that you've seen like fantastic, tremendous growth over the last couple of months, is they're gonna see slight pullbacks. Now keep in mind, Tom, that like funds are gonna get into this thing if they haven't already. And the good thing that you have going for you is that you probably bought Nvidia at a much lower price than where it's gonna fall. Like for example, for me, for Tesla, I bought it in the 300s range. That's like my average, right? So let me just for the sake of example here. So I bought it somewhere around here. So if Tesla goes to 900, that's fantastic. I've tripled my money. If Tesla goes back to 600, yeah, it sucks because we had a pullback, but it doesn't matter because I still have like a $300, 60% gain on my Tesla position. So I'm not really worried about losing my principal. I'm not really worried about, being in a bad position where I'm forced to sell, because what happens is, I sell here at 600 and Tesla prepares for its next leg up at 900 or 1,000. And it's going to be the same thing for Nvidia, right? It's going to be the same thing where, let's say if you bought at 500 or at 400, it's gone up a lot. Yeah, it's going to cool off for a little bit, maybe weeks, maybe months. But it's never going to, generally speaking, with companies like these, look at this trajectory. It's never going to come down to the price where you bought it at. It's always going to come down to like a higher price. So I don't know what you bought Nvidia at, let's say, but if you bought it somewhere at 500, 600, like within this box, so to speak, it's not going to touch that box again unless we have a macro correction, like if we have a big crash or something. So generally speaking, I think yes, you're going to see slower growth, but I don't think you should sell. If you are planning to hold long term, I don't think you should sell here because it's not going to come back to your cost basis. If you're confident that Nvidia was going to come back to whatever price you bought it at, then yeah, you can sell it off, make that quick flip, and then buy back, and nobody's the wiser, so to speak. But I think you're in a good position, right? And this is all if you plan on holding. So yeah, so about 450-ish. Like we bring the box down here, right? Like it's not. Holy crap! We bring the box all the way down here. Like Nvidia is not going to fall to this point, right? And so because look at the trajectory, it's just up and to the right, up and to the right, up and to the right. Like it's ridiculous. Because good companies keep going up, right? Good companies keep growing, and that's the fundamental basis. That's why for me, we had a macro sort of correction in growth stocks where you saw these like big dips, like in Teladoc. Every single company in my portfolio, you saw a big dip over the last couple of months. And I'm not really worried about it because good companies keep growing, good companies keep going up. And if I'm in it for the long term, if I'm in it for several years, who cares, right? Yeah, sure, I might underperform the market over the next 6 months, or maybe over the next 12 months. I might not beat the S&P 500 this year, but over the next 5 years or over the next 10 years, then I think I definitely will, because these companies have higher growth rates, they have stickier products, they leverage technology to create those new paradigm shifts. And Nvidia is a company that's at the forefront of that, right? It's a company that's crucial, it's paramount to that change, because the products that they make are going to be so in demand, and they have such high barriers to entry. Like, you can't have just any company out of the blue create products that can dethrone Nvidia, so to speak, right? Because you need massive amounts of R&D, you need massive budgets for them, you need so many barriers in the way. And so if you believe in the company fundamentally speaking and the products that they make, then I don't think you should be worried at all about these short-term fluctuations, especially if you bought it way down here. Like, you're golden, man. And I think similar story for Docusign. You probably bought Docusign in the hundreds. If you bought at the same time as Nvidia, probably like down here. And you can see, right, like you have this growth, and then you have like this volatility here, and it's trading in this box. Keep in mind, this box is like $60 wide, but generally speaking, it's going to form that new investor base of long-term investors, and it's going to break out of that box to the upside because the company is good underlying. Okay, so let's take a look right now at Nano-X Imaging. Nano-X is a company that, yes, I have been looking at, Stuart. I've been actively monitoring it. I never invested in them though, because honestly, man, like they seem like a sort of like a science project to me, because they're so early days, right? Let me see if Hypercharts has them. But yeah, guys, if you're enjoying this live stream so far, if you think I should do more live streams, just let me know, drop a thumbs up or something. Okay, so let me see Nano-X Imaging. Yeah, so it's not on Hypercharts. Let me just take a look. Let me see if I can get us their investor deck. So this is generally my process, what I do for all of these companies. I don't really like to go on, I don't start with, people's YouTube videos and people's bull cases, because what it does is it really influences my own opinion. The first thing that I do is I just type in on Google the ticker and then investor relations, and then I take a look at, what they're making. So they have a really cool investor deck. They do scans. I think it's for cancer. So medical imaging, preventive scanning. That's a sector that's going to be. Hold on. Is Kathy in this? Because this sounds like right up her alley. This is a sector that's going to be pretty important, in the future. It's something that it can save you millions and millions of dollars. It's a paradigm shift that, it's different from the ways of how we would be working, like how we have been working. 2/3 of the world's population have no meaningful access to medical imaging. The majority of the remaining 1/3 suffer from weeks to months of wait time to access medical scanners. And it's probably expensive as hell too. Okay, so they have this like African child here on their slide. I don't know why. Medical imaging systems are too expensive and complex for mass deployment. X-ray source technology. Yeah, and like it's great, like they're trying to sell me on the technology, but the part that I'm not so bought into is what I want to see, Stuart, more than the technology itself, is I want to see whether they have funding, first of all, and number two, whether they have a plan as to how they're going to make money, right? Because the technology can be, fantastic, and if the business fundamentals aren't there, at least a glimpse, a premise of the business fundamentals aren't there, then how am I supposed to, invest in them? So addressable market, 21 billion global medical imaging market through shift from CapEx to an MSaaS model. Okay, so that's cool. 21 billion market. Weird that I'm talking about medical imaging because that was one of Vuzix's main markets as well. In my video yesterday, I talked about that. So generally speaking, I think that they're going to be partnering with big companies to provide their devices. Is that sort of the case? They're going to be selling their devices or either a subscription model with their devices. So that's what it sounds like. They talk about partnerships a lot here. Generally, Stuart, I would be reading this deck up and down, left and right, every little detail. But since I'm on this live stream and I want to keep it sort of entertaining for everybody, I'm skimming through it. Okay. They've announced new hires. They're expanding their team. Look at that. They don't provide any financial slides whatsoever. So that's weird. Probably because they don't have any financials, right? Let's take a look. Okay, I don't want to sift through their actual financial experts. Let me just see if Kathy is in this. Probably not, but I know it was one of the things that that ARC was mulling at. If you guys know, just let me know in the comments. Yeah, so I don't think Kathy is in this, and keep in mind this would be front and center in her genomics ETF if they were probably making profit. So I don't think that they are. Wall Street Journal is a company that I really like to go to, or a website that I really like to go to for a lot of these financials because they clean everything up for you, and they also provide year-over-year percentage increases as well. So they do a lot of the homework for you. Okay, so this is an annual view. In 2018, they made $5,000. They had $5,000 cash. Today they have 200. What is this? 213, but it's in thousands. So what is that, in the millions? Okay, so I'll check out Affirm after this. Okay, so they have cash on hand. This is good. Well, as of 2020, let's see the quarterly view. Okay, so they raised cash, I'm guessing, sometime in September, probably when they IPO'd. I think that's the case. Okay, since August IPO. So from their IPO, they raised a whole bunch of money, and that money has been slowly dwindling a little bit. That's fine. Let me see. Total assets. So the total assets is basically what they have cash on hand. That's what it is. All of these other numbers are so small. It's what they have cash on hand, and that cash is going to be their run rate, right? So, Stuart, one of the things that I would be looking at with Nano-X imaging, with a company that doesn't have, I don't think that they have sales, but let me just quickly take a look. But if the company doesn't have sales, yeah, exactly. So yeah, net income is down. What I would be taking a look at is cash on hand, number one, and how far that cash gets them with their burn rate. So you can just Google that and just calculate what is their net income, loss or net loss, quarterly or yearly, and how does that correspond with their cash on hand? When will they run out of cash? So, their net losses have been accelerating here, which is not a great thing to see, but they're probably reinvesting in their business, right? So they have a lot of, R&D is not even that high. It's SG&A, so, general expenses. So Stuart, for Nano-X imaging, they're losing money. They have no clear sight into when they're going to be profitable. If that net income number was, the other way around, they were going close to profitability, then that would be one thing, right? But they're not. They're going further away. What's the URL you just used to get the financials? So this is the Wall Street Journal. You can just go to wallstreetjournal.com, Wall Street Journal Markets, under this Markets tab. I just had the link saved here, so I just put the ticker in there. So Wall Street Journal has really clean financials. They take time to update though. So back to Nano-X imaging. The cash is their only good thing, right? They have lots of cash on hand to sustain themselves. Do they have debt? Definitely they do. Okay, it's not that bad. Short-term debt, they also have that. Okay, all in all, not that bad from a liabilities perspective. Oh wow, I think that's my first ever tip that I got. That's really cool. Thank you. So from a liabilities perspective, it's not that bad. I think their cash can cover the liabilities. But Stuart, it's just a question of like, how long can this sustain at this current run rate? And at this current run rate, what is their potential to raise more cash in the future? Keep in mind, man, that right now they can probably, Nano-X can raise cash easily. With a presentation deck like this, it's a sexy deck. It looks good. They're talking about the technology. They're talking about the potential, what they're going to sell. It's like vaporware to some degree. People are going to give them money. But if we have a correction, if we have a crash, if we have instability in terms of the macro conditions, then you're going to see that funding dry up for Nano-X imaging. And that's the thing that I want to avoid, is because in the dot-com bubble, a lot of these companies blew up, and the reason that they blew up was because all the funding dried up. All of these tech companies, these websites will put .com under their names, under their company names, just to get an increase in the stock appreciation. But the moment the funding dried up, like 90% of them went bankrupt because there's no more money. And what happens is, for a company like Nano-X Imaging, even if they have 20 million or 200 million, whatever that is, that's going to dry up eventually. And when it does dry up, your saving grace, Stuart, is if they have more investors ready to put money in. And that's a dependency on the macro condition as well. So I would be looking at these factors. I'd be looking at the run rate. I'd be listening into the earnings calls to hear what their plan is for actual revenue. I'm not talking about profitability right now. I'm talking about actual revenue in the door. But it's not a company that I would personally buy, because my level of risk, my tolerance for risk is I will buy companies like Vuzix, for example. It's a very small company. Compared to Nano-X, I think Nano-X is actually bigger than Vuzix. So Nano-X is actually bigger than Vuzix. 1.34 billion for Nano-X and 1.1 billion for Vuzix. But Nano-X isn't making any revenue. They're burning cash every single month, and they are just solely relying on investors. Whereas Vuzix has been producing products for the last decade, right? They've been selling these products. They're industry standard for these products. And the fact that they have all of these partnerships is really bullish as well. So both of those companies, Vuzix and Nano-X, they're both speculative to a certain degree because they're both small companies. But you can see the difference. Vuzix actually has the light at the end of the tunnel, where yes, you're taking a risk, but it's a calculated risk. Whereas with Nano-X Imaging, it's basically a gamble, because the moment their funding runs out, if it does, then you're screwed. If it doesn't, then you've made it. But even if it doesn't run out, Kathy's in? Okay. But even if it doesn't run out, Stuart, then you have to ask yourself, okay, well, it's still bigger than Vuzix, so it's already like 1.3, 1.4 billion. And the opportunity, what was it that they said? It's like 20 billion, something like that, for the opportunity. So yeah, like you can, what I'm trying to say is, I'm not trying to dissuade you from the stock. I'm just trying to highlight the risks for you, to say that yes, it's a calculation from what their potential is in terms of their total addressable market and their growth rate. I'm sure they're growing like crazy, but it's also a calculation from their cash burn to their actual revenue and when they plan to actually make some money. And if you keep all of that in mind, I think I talked about this in my ranking growth stocks video. You're not looking at Nano-X Imaging in isolation, right? It's not, hey, somebody knocks on your door and says, hey, Stuart, do you want to invest in this or not? And like that's the only thing you can do with your money. The beautiful thing about the market is that you're always comparing it with other stocks, right? You're always comparing it with other names. And so you have to ask yourself, yes, like if Nano-X is good in itself, it might be a yes, right? Because you don't want to keep your money in a savings account. You might as well take the risk, and you could, multiply your money. But it's not in a vacuum, right? You're going to talk about it in relation to other stocks. And if you talk about it in relation to other stocks, I guarantee you that there's stocks out there with a higher total addressable market, a higher growth rate and a lower market cap. And those are the ones that you have to find. Those are the ones you have to pin Nano-X against. I mean, it's a sexy technology. It's on sort of my watch list. I have it. I'm tracking the price for Nano-X because it's one of those companies that I think is an indicator of, just generally speaking, where the market's at in terms of these like speculative companies. I think QuantumScape was another one of these where, QuantumScape as a company was expected to have revenue, not profit, revenue in like 2025. And it was already valued at, I think when it blew up, look at that, right? So today it's 11 billion market cap, but it's at $27. When it blew up, like it was like a 50 billion market cap company. And to have a 50 billion market cap company that's expected to do revenue in 2024, 2025, man, people are freaking crazy sometimes. So I don't know. I apologize if that sort of turned you off to Nano-X, but that's just how I think about it, Stuart. And like that's just, I think those are the types of questions that you have to ask yourself if you're thinking about going into a stock like Nano-X. So yeah, just drop your thoughts. Let me know your thoughts as well. But moving down, again, thank you so much for the donation or the super chat. I don't know what that is. It's my first one ever that I've gotten. So thank you. Corsair has been a perfect for CSP. So far, it's been a free 1K a month. What do you think about Affirm medium term? Okay, so I'm going to talk about Affirm, and then I'm going to talk about Praetorian, the thoughts on Unity's Metaverse, time frame probability, and success impact. That's a great question. Okay, so let me talk about Affirm first of all. So where's Affirm at? Is that? No. Affirm. Cool. I think Affirm is one of the stocks I think that my girlfriend is in, but I'm not. I think she was really excited about I think she's in it. Let me see. I think she was really excited about the potential that it had for after its IPO, but it's been one of those companies that have gotten killed. Affirm's at a 16 billion market cap right now. Yeah, let's take a look. Let's take a look at it. So moving away from Nano-X. So again, this is all I do. Just ticker symbol and then IR, right? And the first thing that should pop up is the investor relations. I've taken a look at Affirm's deck before. It's really interesting. I think the company is like really sexy and what they're doing is really interesting. I can't remember why I never invested in them. I think that they have huge debt. But actually, let's take a look at their fiscal third quarter results. Okay, so GMV was 2.3 billion, 83% increase, amazing, excluding Peloton. Cool. Okay, so they provide a lot of, I guess Peloton, it would make sense, right? Because, okay, so what Affirm is, sorry, I'm just talking to myself. What Affirm is a company that is, what they do is they provide pay-as-you-go, I believe, installments. So, yeah, okay. So installments powered by Affirm for more than 10,000 Shopify merchants. We expect this number to significantly increase as we move towards general availability in June. So essentially what they do is, if I'm buying a big ticket item, I can pay monthly or I can pay in increments as opposed to paying for, like, let's say a Peloton for $2,000, I can pay in increments. So it seems like something like 30% of their business was Peloton. So, okay, cool. I'm in Peloton. It's a big ticket item. People want to use Affirm for it. Whatever. It works. It's synergistic. Active merchants more than doubled to nearly 12,000. Active consumers grew 60% to 5.4 million. Let me see what time it is. Okay. Transactions. Okay, this is all great. Revenue was 2.3. Let's see if they have the charts. Yeah, there we go. Okay, so GMV in billions. So they're growing in terms of revenue, 1.2 to 2.3 billion, 138 to 230. Transaction costs are going down. Okay. Net loss. Oof. Why did this widen so much? Operating loss widened. Okay, revenue less transaction costs. What is going on here? So I want to know why this widened so much, this net loss. Okay, so their consumers are going up 3.3, 3.6, 5.4. Transactions per consumers are staying pretty stable. Keep in mind this is 2.1 transactions per each consumer, I believe it is. Active merchants are going... Okay, so the active merchants going up, this is a really good thing because you want more merchants. The more merchants you have that are offering through Affirm, then that's how you get more consumers. It's one of those businesses that you don't start with the audience, you start with the merchants, and then you go into... That's how you get more... The network is wider, and so that's how you get more consumers. Let me take a... Okay, here we go. So cash... This is really good. They have a lot of cash here. I think this is probably from their IPO. They were a recent IPO. Total assets, fantastic. Total liabilities are pretty much the same. No, this is something's... Oh, this is the total. Okay, so total liabilities are about half their total assets, 2.3 billion. Funding debt. They have a bunch of debt. Convertible debt, they paid that off, so that's good. Why didn't I invest in Affirm? Hold on. Revenue. I know that there was a reason. I think I was taking a look at their... they have an investor deck too. So yeah, so one of the main questions that I would be asking is why did their net loss widen so much? And also, I'm curious to see the seasonality of the business because I would imagine it's a very seasonal type of business as well. So let's take a look here. Okay. So you can see their revenue streams here. They're growing 66%, 13x for a $10 billion company. Okay. They probably have a huge total addressable market, to be honest with you, because of what they do, the type of business they're in. Operating income has gone down as revenue has gone steadily up. This normally wouldn't bother me. I just want to understand why it is. It seems like third quarter is consistently a bad quarter for them. At least it was that way in 2020 and also in 2021. So generally, these quarters will mirror other years because if it's a seasonal business. So the revenue going up is the main thing that I really care about, the income going down. But it's such a big drop that I just want to understand why it is. OpEx, cool. Yeah, I mean, look, it looks solid and it's growing fast. I think the main questions that I'd ask is like, what is up with that one-time loss? Number one, and then number two, what is their total addressable market? And learning a little bit more the qualitative aspects of them expanding to new industries with regards to like new merchants. If we have a clear plan on their merchants, like Peloton being 30% of their business, yeah, it's great for where the business is right now, but that's a bad thing, right? Because it's a high concentration into one customer. You want them to have lots of merchants so that they don't have a strict dependence on just any one merchant alone. That's my 2 cents on Affirm. Again, I don't know so much about the business. This is my first time really looking at them, I think. So I hope that provided some color or just some direction of like what you can look at next. Okay, so let's take a look at Praetorian's question. Please share your thoughts on Unity's Metaverse, like time frame, probability of success, impact on society. Okay, well, this is a big question. It's one of those, you're kind of asking me to predict the future here. But look, I think one of the main things with Unity, one of the main things with Unity is the image that Loop Ventures brought up. That it's in my videos as well. Like the metaverse scenario with Unity is sort of more wishy-washy. It's more up in the air, right? It's something that It's a question of like, will the metaverse happen or will it not happen, and how will that look? Before it's a question of like, what will Unity do about it? The metaverse is something that Roblox as a company is also leaning into, but it's, at the very least 5 years down the line, more likely 7 to 10 years down the line, right? What we should be looking at for Unity right now is the industry, enterprise clients. If they can branch out of gaming specifically, then you're looking at a really diversified business, because like Unity for gaming, and keep in mind, I think Unity is my third or fourth largest position, but if it's just a gaming company, it's pretty expensive, even at 27 billion. Keep in mind, I was buying it at like 30 or 40 billion, right? But even at 27 billion, it's not cheap for just a gaming company. But if we go into the industry enterprise and we find out that, hey, Unity is working with 9 out of the top 10 auto manufacturers in the world, well, it makes sense, right? That branches out their potential clients and then their client mix. The actual metaverse scenario, that's where we get to a scenario where Unity is like Adobe, or Unity is, I don't know, one of these huge tech staples, right? But it's more wishy-washy in terms of whether we're moving in that direction or we're not. I think it's something to do with like, there's a lot of factors that are outside of Unity's control, is what I mean, whether society moves. So a couple of the factors just off the top of my head, and I've talked about these in previous videos before, it's like decoupling IP from a lot of these video game providers. What I mean by that is, I think I talked about this in an NFT video, where if you had the opportunity to decouple the IP of like in-game skins for Fortnite that I win, and me being able to transfer them to different games, then that's a indication that we're moving in the direction of a metaverse, because let's say Fortnite at the moment owns all of their content, all of their skins, and it removes a level of stickiness for me as the gamer, because why would I grind 24 hours to get a skin when in 2 months I might not even play this game anymore? So that's one of the things. If we can move to a world where these gaming companies are decoupling their content, their IP, and maybe licensing it out, or maybe doing subscription based. Number 2 is the hardware moving in that direction. Yeah, we're talking about Oculus, we're talking about companies like Vuzix, and we're talking about all of these, like, Facebook is working on them, Google is working on them, Apple Glass is expected to come out in 2022, 2023. So it seems like the hardware is moving in that direction. You're going to need that adoption, that software. In my Vuzix video yesterday, I was talking about like how this is the early days of Apple in 2007, or the internet in 1990s, where you're building the first processors, the first semblance of software. Unity is going to be a big part of building that infrastructure. But right now, what Unity is known for is they're known for a gaming engine, first of all. And second of all, they're known for a gaming engine on mobile specifically. Like, people, at least analysts, they aren't even looking at Unity's opportunities past that, because of these external dependencies, namely the hardware, the IP for these games, and just also, I think overall, this metaverse scenario is something that there's several steps that have to happen before the metaverse scenario happens. And one of those steps is, like I said, this AR and VR, like this adoption change that has to happen. If we get to a point where in 2023 everybody is wearing, let's say, Vuzix glasses or Apple glasses, and they're spending maybe just as much time on their smart glasses as they are on their iPhone, then we can revisit this conversation. I can say, hey, look, Unity has a high probability of success impact on the society. There's a high probability that this is going to happen, and this is what the time frame looks like. But since we don't know, we don't have the prerequisites from a societal macro perspective to justify saying, hey, Unity is going to be a winner in the metaverse space, because there could be a world where we don't even move in the metaverse space. So I'm not sure if that helped. I hope it did, but that's just my thoughts on the subject. Okay, so I think I can take a couple of more questions. and then we'll call it. I think we've been streaming for 65 minutes for our first stream, which is pretty good, I think. So if you have questions, just drop them in here, and I'll pick them up as I go along. One other thing that I want to flag is sort of a self-promo, if you will. I did open memberships on YouTube, so maybe I can go to incognito, and then I can go to YouTube. Yeah, of course. So if I go to YouTube here and I go to my channel, also if you haven't subscribed yet, definitely do that. Okay, so 14 watching live now, my stupid face over here. But if I go to one of my videos, I think there should be a join button here. I'm not sure if it's because I'm on incognito, but there should be a join button, and essentially in that join button there should be several tiers, one if not several tiers, where I talk about where you can sign up to be a member. And the membership perks they vary, but essentially one of the tiers is just like supporting the channel, which is like a donation essentially monthly, and then the other tiers are having a Discord channel and having private live stream, so similar to this live stream, but having it private so that we can only do members. And then other tiers are like specific tier merch. So I'm going to be creating merch, like physical merch as well as digital, like badges and stuff, where you can sign up for that. All of this, I did it last night. I'm not sure if it's been approved or not by YouTube, but I think if you see the join button right beside there, then probably you can see all the tiers too. Okay, so that's my whole spiel on self-promo. We can close this now and talk about another one of your questions if you have it. What do I want to talk about? Yeah, it's so crazy. Like these, looking at these companies day in and day out, it's just so weird because it solidifies my bull case in a lot of these companies. Like I could spit out my bull case for all of the companies that I hold right now off the top of my head with actual statistics, because I'm so like immersed into that world. Okay, so kind of a niche taker, but thoughts on Figs, direct-to-consumer medical scrubs, but they have aspirations of becoming a lifestyle brand, i.e. Lulu, insanely good financials, but seems risky short-term. Figs, all right. That's quite a vertical graph. Oh, hey, Juan, what's up, buddy? Nice of you to join, appreciate it. So I'll get to your question right after. Figs, very vertical chart, really interesting to see. $6 billion market cap. Let's take a look at them. Direct-to-consumer medical scrubs. I don't know, call me crazy, but I don't know how big of a industry that could be. It seems pretty niche, but let's take a look. So, DTC, healthcare apparel, and lifestyle brand. How are you a lifestyle brand if you're DTC medical apparel? Like, who is walking around with scrubs to go like shopping or whatever? Like, I don't know how those two things coalesce. I mean, look, I'm sure their financials are fantastic. I'm going to take your word for it, for their financials. I don't know. Like, I think it's just weird in my mind. I wish they had an investor presentation, because I would love. Actually, let's take a look at their products. It's just weird in my mind because I don't know who the target market would be for this. Like, if it's DTC, medical scrubs that they're partnering with like hospitals or whatever, then that's one thing. But a lifestyle brand on top of that, then it just, I don't know. I think it's just weird. I don't know. I think it's just weird. 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 I think it's I'm not sure what their total addressable market would be. I mean, these things look good, but I still wouldn't be walking around in medical scrubs, especially if I wasn't like a healthcare professional, right? So you're sort of limited to your target audience in terms of like medical professionals, because like who would wear scrubs if they're not, unless it's like Halloween, and I'm not going to wear them. It's kind of comical, but I think they want to do shoes, socks, jackets. Okay, like if they want to branch out, they want to branch out. But to your original question, like becoming a lifestyle brand like Lulu, come on. Like I think that there will be a lot of intermediary steps for them to actually get to that place where they're a lifestyle brand like Lulu, right? If they're a DTC, so here's the thing, right? And this is a point on branding in general. If they're DTC medical scrubs, to sort of let people know on the DL that you are in the healthcare space, which is a positive virtue signal, post signal. Ugh, come on. I hope I hope people aren't actually buying it to just virtue signal post a pandemic that they're wearing scrubs to like show off. Okay, so here's my point on branding, and I think it's an important point to be made, because if you're a DTC like healthcare apparel company, then generally speaking, you want to be partnering with hospitals, you want to be partnering with clinics, you want to be actually going to the healthcare professionals, you want to be going to the people who actually use these products. If you're a lifestyle company, then you want to be casting your net much wider in terms of the target audience, the target market that you're after, right? And so those two things conflict with what your actual like goal is as a business. And yeah, their financials might be great. Yes, it might be trendy. But the main question in my mind right now is, what is the thing that makes this not a fad, right? And if not a fad, what is the thing that makes it not a niche, right? So it could be a fad where like, okay, we're coming out of a pandemic, they have blowout sales because people want a virtue signal post-COVID, which is the stupidest thing in my mind. But, people are stupid. So let's say that they want to do that. That's fine. Then that's a fad. Right? But if 3 years down the line, 4 years down the line, the fad dies down, what are we left with? Are we left with just a niche that healthcare professionals use them because they're more comfortable? And I don't think there is like a lot of restrictions on, and this is, my ignorance too. Like I don't know if that there is a lot of restrictions on like what you can wear like under your scrubs, but my point is, if it's a fad, then the fad is going to wear off. And what you're going to be left with is a niche. And that niche is a limiting factor to their total addressable market, because healthcare professionals are going to use them. I'm not sure who else is going to use them, right? So for them to be successful, yes, maybe they can be successful. It's a matter of like what their liabilities are, what their cash flow is, what their revenue numbers are. But for them to be a Lulu type influence, no, it's not going to happen. And if it does happen, what they need to do is they need to branch out of this. They need to create another brand that's like Figs Apparel or something like that, and then make this brand like Figs Scrubs, so that they can widen their net of potential target market, potential users. And they need a lot of time in between to actually form that user behavior. But it's a long shot for sure. Okay, so Juan asked a good question that I really want to answer. I hope that answered your question on the Figs. I know that we didn't look at their financials at all, but just taking your word that they were good. So with regards to Juan's question on when I close out my positions, do I have price targets? There's a couple of scenarios I close out my positions. I'm not sure, Juan, if you were watching when I talked about Roku. One of my biggest regrets for Roku was that I sold out way too early, and I felt like an idiot if I was buying higher, right? So when I close out my positions, I think it has nothing to do with the price. It's all to do with the story. So I don't have price targets for a lot of my positions because I'm more looking long term to hold these companies for years. But there are cases where the story changes, number one. And then number two, there are cases where, subjectively speaking, for a portfolio composition, my personal reasons for investing in that company changes. So for example, like Cloudflare. Cloudflare, I love the company. I think that they're going in great places. They're as soon as they left my portfolio, they went on this buy soon list. But it's something that I wanted to consolidate my positions. So regardless of whether I was feeling bullish on the company, or regardless of whether I think they're going to be successful. It's a portfolio composition decision, right? So that's one of the cases where I would sell my position. No particular price target, just when I made that decision to consolidate, Cloudflare happened to be trading at $100. Generally speaking, I don't want to sell anything at a loss. I think that's like Warren Buffett's first rule. But when I do sell things, it's based on the story. If Cloudflare comes out in their next, well, maybe not this one because I already sold it, but let's say if Revolve comes out on their next earnings report and they say, hey, like we actually saw a declining revenue and we saw, something that didn't go as planned, then I would be more thinking about, okay, when do I sell them? As opposed to, okay, I bought Revolve at $16, it's up to $60 right now, I'm up whatever it is, 250%. Yeah, 270%. I should sell Revolve because I'm making a lot of money on it. Yeah, like it's a consideration, but it's also like the reason why I bought it wasn't for it to be $60, it was for it to be, a large company. I keep in mind that like if Revolve goes to like $100, then I'm going to be thinking about selling it not because of the price, but because of the market cap and where I think that market cap should be at that time. Going back to our original point of like sometimes when a company goes up too much too fast, they're stealing potential gains from themselves in the future. So that's one of the other considerations to make as well. Okay, cool. So yeah, you sold Roku too early too. Man, I feel like a lot of these companies that IPO'd, with any of these companies, you don't know that they're going to be big until they're big. And so if you're in the market for 2 or 3 or 4 years, you've seen some of these names super cheap. Like when I first was looking at Apple, it was like $100 before the split. and then it went all the way up to like 400, 500, and this is a matter of 3 years. So it's really crazy, and this is something that over time you're going to make mistakes, and as you make more and more mistakes, your conviction is going to build more and more, and you're going to get these principles. Principles is one of the things that I talk about a lot on the Fundamentals of Investing ebook. It's one of the things that I highlight my own principles to investing and why I have the strategy that I have. It's not the sexiest strategy. It's not the best for content creation, to be honest with you, but it's something that works for me, and it's something that has formed in me over time. So if you haven't checked out that book, definitely make sure to check it out. It should be in the description for any of my videos. Tom, okay, what's the company you're most excited to IPO soon? Well, okay, so I think, what's the company I'm most excited about? So Canva is one of the companies that I use for all of my social graphics. I'm not sure if they're planning on IPOing or like how that looks, but it's an Australian company. I'm not sure if it's going to go public. 15 billion, yeah. So Canva is a really fantastic product. OnlyFans, to be honest with you, because their like financials are crazy. I think it was like a Bloomberg post that they were talking about this IPO. 1 billion. They just raised more money. Seeks new funding at valuation above 1 billion. It's a profitable company. Yeah. So there's this, but there's this piece. But I don't think that piece is going to go away anytime soon. Like that's a huge industry, and God bless them for wanting to branch out of that. I don't know how they're going to do that. Their brand is pretty solidified in that space, but $2 billion in sales last year, 20% fee, 400 million in revenue, growing at 100% plus. Like, get out of here, man. I am jumping on that as soon as that IPOs. I don't know if it will or not, but like, 1 billion valuation, let's say, and they're making 400 million in revenue and 2 billion in gross merchandise value. Get out of here. That's a beautiful fundamental company. So Patreon is another one. Yeah, Patreon is another one. Interesting though, when I was making my tiers, Tom, I was making them last night for my membership tiers. YouTube is really going into that Patreon route. So YouTube said, these are your tiers. We take a portion of them, and they had all of the perks, and all the perks were similar to what Patreon offers. So very interesting, especially because YouTube is like 40% of Google's revenue. But Patreon is going to be an interesting one. I have a list. I don't know if I can pull it up right now, but I have a list, Tom, just a notepad. And what I do, and I think it's a good exercise for everybody to do, is take a look at all of the products you use, whether they be websites, like digital products or physical products, of only private companies. So Patreon was in it for me. Canva was also in it for me. And Squarespace was in it for me. And also Airbnb. This is before they went IPO. And just take a look, right? And the reason Squarespace and Airbnb were in it for me was because I love the products. I use the products, for my personal website and also for whenever I'm going on vacation. The reason I didn't buy them at IPO was just financial reasons. So all of those sort of factors have to be a part for you to actually make that decision. But yeah, make that list. So for me, for IPO, definitely Patreon, OnlyFans, Canva. There's a whole bunch of private companies that make really cool products too. Yeah, the thing is, literally you're number one. But the thing is that you don't know when they're going to IPO because they just raised new funding, right? So they don't need to IPO. The problem is that when these companies IPO, they lose a lot of their ownership. They lose a lot of their voting rights, right? Because they diversify, they become a public company. Number one. Number two is now they have to show all their financials. They have to be scrutinized. They have to do these earnings calls, and it's just a headache from a paperwork organization perspective, right? And so if they can get funding and they can retain control as a private company, they're going to do that before they IPO. Similar to SpaceX. This is why SpaceX, which, again, back to Tom's question, would probably be among my top 1 or 2 or 3 companies to IPO. I think if Starlink's going to IPO, I'm going to be looking at that on IPO day. But SpaceX is not going to be IPOing anytime soon because Elon just has the money to keep it funded by himself, and he doesn't want to give up any of that control. He wants to retain all of that control, right? So it's a matter of the direction of the company, the decisions, how much of it is coddling stakeholders, coddling analysts, how much of it is hype in order to raise money. And it's just all a matter of funding, right? And so if these companies don't need the funding, then going public is not the right decision for them. But yeah, SpaceX is going to be a good one. It's going to be an interesting one. I think Starlink should be IPOing towards the end of this year. Wow, I can't believe we made a 83-minute stream on the first ever stream. This has been actually really fun. I think I'm going to incorporate more live streams in the future, and definitely members-only live streams as well. I needed to set up, I'm using OBS for this one, so I needed to set that up, and I'm still learning about it, so you're probably going to get some fancy, subscribe now or whatever buttons coming up soon, but yeah, this has been super duper fun. Maybe I can take one more question and then I can call it. On the good news though, the plus side, the market's been rebounding ever since we started this live stream. I think when we started, it was sort of down mostly for the day, but now it seems like a lot of the companies will end up. I think let me share with you one of my the best feelings that I have in the market is because the companies that I'm in, being low market cap companies, highly speculative growth companies, they're very detached with the indexes. And the worst days that I have in the market is when all of my companies, because they all trade together, they all trade in a group, because they're all in that growth bucket, right? And so institutions buy them all together. There's days when all of my companies trade down and the indexes trade positively, like Dow, S&P, and NASDAQ are sometimes all up, because like NASDAQ, like Amazon just drags it up or down. But there's days like today where, the majority of my companies are up, or even like yesterday where they were all up. And if I look at the indexes are down. That's my guilty pleasure. That's my guilty pleasure in the market, is when the indexes are down and my whole portfolio is up. The best feeling in the world. Just here's the thing, right? Because if the indexes go up too much, like there's worries about like a bubble, inflation, we need to go down. The problem is when the indexes go down, generally speaking, all of my companies will go down as well. And so when the indexes are up and my portfolio is down, then that like delta, that variance of like people saying there's a bubble, like we're going up too high, and then my stocks are down. When the index eventually corrects or crashes, my stocks are going to be double down, like even more. So honestly, my guilty pleasure is when my companies are up and the index is down. It's just best feeling in the world. Thank you for doing this. I appreciate your product user experience. Yeah, like here's the thing, and this is essentially why I wanted to open this channel, is because I've been working in tech for like 5-6 years now, and I'm a product manager in my day job, and there's a lot of insight that you get from a common sense perspective, like a logic, poking holes in ideas, breaking stuff down, number one. But there's also insights that you get on tech specifically, and like what types of tech works. I've been working on e-commerce platforms for years, so I know sort of good and bad e-commerce flows from just a product perspective of how they lay out their infrastructure, how they do their functionality, and just their user experience in general. So that's number two. And then number three is that like it gives me special insight on actually finding sticky products. And like what I would do is I would be a PM, I would have my own team of designers and devs and sort of work with them to build my own products. But at the same time, I would, in my free time, do investing. I would learn on growth companies. I would learn on, all of these investing principles. And I only, when I started the YouTube, or the Instagram, I should say, merged those two lives together, and have found that once I merged those two lives together, I really found a disproportionate reward to risk of my own portfolio. Because what you'll find is that this is that Peter Lynch idea that everybody has a circle of competence, and that circle of competence is unique to your experience, to the world around you, to your social circles, right? And to the products that you have in your life. Because you have to understand that like analysts on Wall Street, they're people too, right? They're just, they're going into the office, they're researching. A lot of these companies, like Peloton is one of the companies, MongoDB was another one too that I mentioned in the fundamentals book. Those are companies that are just numbers on a screen to them in terms of the financials, in terms of the actual like fundamentals of those companies. They've never tried the products themselves. They don't know what the products are. They know as much about them as I do know about figs. It's a paragraph that I read on a website, and it's just immediate bias that I implement. So with Peloton, you still have that bias with a lot of these analysts, right? They say, oh, like, it's an exercise bike with an iPad on it. I'm like, okay, that's jumping to that conclusion. But the problem is that, or I should say the opportunity for you is once you start trying these products out, and once you start seeing how excited the people in your circle are around those products, immediately you have an edge over the analysts, because you can invest in something first. Invest in something when they're still doubting that thing, when they're still, sort of putting it down. And then when Peloton's, $100, keep in mind, Peloton, my first purchase of Peloton was $27. Where is it? Yeah, so I bought it down here, $27. It was my first purchase. It was, not March. It was sometime like January, February of 2020. Yeah, so somewhere around here is where I bought Peloton. Somewhere around there. And why did I buy it there? Because people in my circle were excited. I had friends, I had, people in my circle that were like, oh, like, so-and-so has a Peloton in their building. Like, we're all going to go hang out there, and we're going to, like, take turns on the Peloton. Like, that product, that level of stickiness, it wasn't something that you found. And by the time analysts caught up to it, they caught up to it way too late, right? And the retail investor had got him first, and they made money. The person that I mentioned on Twitter yesterday, Peloton Gains, Bill, he's a person that made a lot of money on Peloton. And the whole reason was because he had one in his house. He knew the stickiness of the product. And so, bringing it back to your point, so the first Peloton, $35 is an amazing price, right? But you tried the product first, and then you bought the stock. And that, I think, is the most important thing. Because if you try the product, then what happens is you automatically know the qualitative aspect instead of the quantitative aspect, which is just the numbers and the financials. And that's going back to my product experience. Being a product manager, I get to test out a lot of e-commerce flows. I get to look at the best e-commerce flows just to get inspiration on what features, what functionality I want to be building for my own day job. And by doing that, I get to see products that are good and products that are bad. And that gives me an edge over just an analyst on Wall Street who is just seeing numbers on a screen. And that edge is just time. It's just time that something is speculative until it's mainstream. Something is knocked down and put down and insulted and ridiculed until it's praised. That's just human nature. That's normal, right? There will come a time where Peloton is a staple, right? Where connected fitness, where working from home is a norm, and these analysts are going to say, we knew this was coming all along. It's exactly what the same thing that they did with Tesla, right? With Tesla, what they did was they talked smack about it, and they said, EVs, it's never going to happen, blah, 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 ICE, they're never going to beat out Ford. And when Tesla reached the peak, everybody is saying, Tesla's the future, Tesla's going to, it's human nature. Everybody wants to jump on the bandwagon. They're going to jump on the bandwagon eventually. But the fact that you can invest in something before Wall Street jumps on the bandwagon, that's my second biggest guilty pleasure in the market, is if I find a Corsair or if I find a Revolve or just one of these small companies or a Vuzix and I buy it before the market buys it, oh boy, that is the best feeling, because you're never going to beat the market by investing in indexes, by widely diversifying, by investing in the same types of companies that the market is investing in, right? Keep in mind, the S&P 500, the NASDAQ, they all have these companies that, the Adobes of the world, the Salesforces of the world, the trade desks, and Amazons, these hundreds of billions of dollars worth market cap companies. But my whole strategy is to look at companies that are under $10 billion, under $20 billion, because those could be the Adobes and the trade desks of the future, right? The Amazons of the future, the companies that, in a world where Fiverr is $50 billion, if I invested them when they're $5 billion, that's how you beat the market. Even if you don't beat them in the next 6 months or in the next 12 months, that's how you beat them in the next 5 years, in the next 10 years, right? So if you think the same as the herd, and I don't mean the herd in a bad way, I just mean if everybody's tracking the indexes, the stocks in the indexes, if they're in your portfolio, you're not going to outperform with them. If you think the same as that, you're not going to outperform. You have to sort of think differently and take more calculated risks in different companies before Wall Street gets their eyes on them, before Wall Street starts praising them, right? If you see articles, every single day, Tesla this, Tesla that, Tesla's great, Tesla blah, blah, Tesla interview, that Tesla's already, $500, $600, $700 billion company, right? You'll never see articles that are Vuzix is this, Vuzix is that, because it's not there yet, right? So I guess that's my whole point, that's my whole spiel is you have to front run the market, so to speak. You have to get in before they get in. Okay, I think that's a solid note for me to close on. I appreciate you all. Hit the subscribe button if you haven't done so already. Feel free to drop a donation or add the membership if you like these videos. And more importantly, let me know your thoughts on live streams in general, because I think it's something that I want to be incorporating more into what I'm doing. I know that we hovered around 10 users for the last hour and a half, and that's fine with me. I'm not too bothered by the numbers. It just, I want people to feel that they had value out of these sessions. Sometimes it was me rambling, but it's companies that I'm talking about here that I wouldn't normally talk about in my normal videos, because if I'm not going to be investing in Roku, then why would I be talking about Roku or any of these other companies, right? And so that's the opportunity with the live streams. So that's what I'm going to leave you with. I think I really enjoyed this. I didn't expect it to go 95 minutes. It was a lot of fun for me. But yeah, let me know if it was the same with you. Feel free to reach out to me on Twitter, on Instagram, or on YouTube as well. You can just comment below. And yeah, I will catch you on another episode. And this has been the Fundamentals of Investing podcast. Thank you so much for